All right, hi there. This is Rob Hanna and from Quantifiable Edges. Today I'm going to be talking about quantifying seasonality and how seasonality can be used within your trading plan in a quantified manner. Before I get going, I did just want to give you a brief minute to look at the disclaimer here. We're going to be looking at a lot of hypothetical stuff, and that is no guarantee of future results. It's a great way to learn about past market behavior, but it doesn't mean that the market's going to continue to act that way. Also, I'll note that none of this is individual investment advice. While I am associated with an investment advisor at this time, I am not your investment advisor, and this is general knowledge that I'm discussing here today. Excuse me. Okay, so we're going to talk today about a few different things. First of all, difficulties that some people have using traditional approaches to seasonality. And really, these questions are all kind of lead into one another. Does playing good and bad days really produce an edge? That's something that is difficult to identify when you're looking at things that happen fairly rarely. I'm going to give you a sample of some seasonal approaches. I'm going to talk about how to build a seasonal approach that provides an edge. We'll talk a little bit about the Quantifiable Edges seasonality calendars and the functionality that comes with them. And I'm also going to show you a way that you could apply the calendar information to a sample swing trading system. So we're going to look at a few different models. I'm going to show you how to build a model. I'm going to show you what goes into the seasonality calendars and answer questions all along the way. Before I get to it, really get into it though, let's talk about what I mean by seasonality. I'm sure most of you are aware of the concept of seasonality, but simply it's a way to analyze market tendencies around certain times, right? So these could include times of the week, times of the month, times of the year. If you're a day trader, it might be time of day. Could be cycles. So for instance, in the Quantifiable Edges market timing course, I discussed the best and worst 6 months. I discussed the presidential cycle. So it could be long-term cycles like that, or it could be specific to things like holidays or Fed days or different events. Okay, so there's a lot of different ways to look at seasonality, but basically we're looking at periodic happenings. All right, so seasonal studies are often very interesting to people, and they tend to often be some of the most popular posts I put on the blog, for instance, but rarely have I seen people build seasonality into their trading plan. And there's a few reasons why people might find it difficult. One is that the setups might be infrequent, right? So if you're talking about holidays, performance around Thanksgiving or Christmas or something like that only happens once a year. So it's tough to have confidence in the reliability, especially if things don't happen very often. Is it a random streak you've been looking at, or is it a real edge? And with that in mind, how do you adjust if price action going into the seasonal period happens to be very strong or very weak? Does that make a difference? Seasonality really is only one small input into what makes the market move. I believe it is an input, but how do other inputs affect seasonality? And then can you use it as a system on its own, or is it better as a filter within a larger system? The great thing about all these questions is that they can be answered if you have enough data. And that's what we're going to look at doing, is trying to answer these questions with some real data. So really it comes down to, does playing good seasonal days and bad seasonal days really provide an edge? You see a study like the ones I published that says this day or this week has closed higher a certain percent of the time in the last several years, and you think, wow, that's interesting, that's cool, looks like there's an edge in moving up, but how valuable is that information really? What are the odds of you having a winning trade if you took a position based on that information? Because now that information's known, that streak that I just shared or that someone just shared is over. It may continue, but you can't buy the past profit curve, right? The hypothetical. So what would your returns be like if you took information like that and consistently utilized it? Right? If you see something that has, hey, this is a 90% win rate, no, you're not going to win 90% of the time, but you may win 65 or 70% of the time. So is there ways to determine whether the information you're getting is valuable? And that's something to think about when you're looking at seasonal studies and even other kinds of studies as well. So I'm going to show one approach to start off, and it's got very limited value, but I want to share it as an example of a way that it's probably more of a streak and not necessarily a valuable piece of information. So if someone were to look at 2019 and break it down by day of the week, what you would find is that Fridays were by far the best day, right? 2/3 of Fridays in 2019 saw the market rise. And Fridays also had the highest average profits and total profits, excuse me, over the entire year. And it really wasn't all that close. Thursdays are pretty good as well. Monday and Tuesday were not good. Tuesday had the worst winning percentage, and Monday was the only day that saw net losses in 2019. So if you took this information at the end of 2019 and said, all right, I'm going to avoid Mondays and Tuesdays, and I'm going to go heavy on Fridays, well, this is how it would have worked out in 2020. The reverse happened, right? Monday and Tuesdays were actually the best days of the week. Friday was one of the worst. It was the worst from the standpoint of the percent of them that rose. It was second worst from the standpoint of net profits. So what the issue is here, I believe, is that we're taking a pretty narrow look, and we may just be identifying streaks. Let's just look at Mondays for a 1-year period. All right, now let's take the next year and trade off of that. That's a bit too narrow. Also, tendencies change. All right, and that's not just something that happens specific to seasonality, but the concept's really applicable to all kinds of indicators. Market dynamics change, and sometimes we can guess why, and sometimes we can't. But sticking to the day of week theme, I want to show you one quick example of a long-term chart where you see tendencies changing. All right, so this is a study I've shown many times over the years, and personally I still find it remarkable. It's a simple study. It just looks at performance in the SPX from the close on Friday, or Thursday if Friday was a holiday, through Monday's close. So it's just really action from the day before Monday's close to Monday's close. Just a day-a-week seasonal study. What we see here is that for over 40 years, from 1947 through 87, the market consistently struggled on Mondays. Skipping Mondays would have been a great strategy, and it would have allowed traders to enjoy a shorter work week as well. But in October 1987, what happened was we saw the worst Monday of all time. And then that was it. After that, Mondays stopped being bad. Instead, they started falling in line with most other days, and that lasted for about 25 years. Then in 2012, Mondays again started to underperform. They were not as negative as they were in the 47 to 87 period, but they didn't participate in the bull market that was occurring during the rest of the week. So a few takeaways here. One, Mondays provided an edge that was worth factoring into your decision making for a long time, a 40-year period. At some point, that changed. And then it changed again. So, as I've been saying, seasonality is not static. If you look hard enough, you should be able to find certain days of the year that have had winning or losing streaks just by chance. The seasonality models look at seasonality in numerous ways. So, certain ways of looking at seasonality may be more impactful during different time periods. For instance, a day-a-week filter likely would have been beneficial pre-1987, and perhaps since 2012, based solely on the Monday study we just looked at. But different seasonal factors will fall in and out of favor over the years, and you want to have systems that will be able to recognize this. So let's look at a simple day-of-month model that is what we call machine learning based. So to build this model out, all you would do is sort the data by calendar day of the month. So what is the return on the first of the month, the second of the month, all the way through the 31st. You could build a model similar to this that uses trade days. You could normalize the calendar days so every month has 1 through 30 rather than it could be up to 28 or 30 or 31, right? There's a lot of, you can do it with moon cycles if you want, or however you want. But I kept it as simple as possible for this example. We're just looking at calendar day of month. Then, after establishing the different days, what we do is we measure performance over some rolling time period. And you can do this over periods of years, or you can say number of instances I want to look back, whatever it is. Generally, when I'm doing this, I find 10 years or more is really what you want. You want to have at least 9 or 10 years. And so this model that I'm about to show, all this did is it looked at calendar day of the month over a rolling 10-year period. And this is what we call a machine learning approach. So we don't tell the model what the best days of the month are. We're not saying, hey, we know the first of the month is typically bullish. Let's go back and see how the market would have performed if you were only in on the first day of the month. What we're doing is we're saying, all right, you define what the best days of the month are and just give us the stats. And the first day of the month might have a 62% win rate over the last 10 years, and the second day of the month might have a 50%, and the third day of the month might have a 48%, and the fifth day of the month might have a 58%, whatever it is. So once we know what the odds are coming up to the next day, then we can say, all right, well, the stats over the last however many years, whatever our period is that we're measuring, say that we've got a 55% chance of making money tomorrow based just on day of month, so I'm going to go long. Or we've only got a 49% chance, so I'm going to step out of the market. And that's what this next, and that's all the model is doing. So we identify the days of the month, we see which ones are best, and then we use that information going forward. And in this way, you can roll all throughout time to see how the market would have done. And that's what this little performance report does. Okay, so this shows performance on days where you saw a win rate of at least 50% and an average profit factor of at least 1, meaning that you had at least a 50% chance of making money, and over the period measured, money was made. Right? It wasn't you were up 48% of the time, but the losses were bigger than the gains, and so you lost money. Doing that would have generated this price chart in the S&P since 1940, just with this simple seasonal model that just looks at calendar day. All right. It would have been in the market a little over 50% of the time, and it would have posted an annual return of about 8.6%, versus a 7.3% if you were in the market the entire time. This does assume an interest rate on cash starting in 1957. Up to 1957 there was none, but we were able to get interest rates for overnight Fed funds, which is the lowest rate I could find, going back the furthest I could find. And so there was a small amount of interest on cash earned when out of the market. Okay, so this is pretty impressive, the difference in the results just being exposed half the time based on simple day of month. Okay, if we look at a drawdown chart, which is next, we see here that most of the drawdowns were significantly reduced as well. You know, if you look back into the 40s and 60s and 70s, the largest drawdowns here were in the 15 to 20% range using the model. Yet, if you held on the whole time, there was a number of drawdowns that were 35%, 25% here, over 45% here in the 70s. There were some very large drawdowns that were not drawdowns if you just used the simple calendar day of month model. The drawdown, there were some larger ones in 2000 and last year as well. But even these mostly were not as bad as buy and hold. So of course that's how, you know, if we go back and look at the profit curve, the reason that this is outperforming over the long haul is not because it does better on the up days, it's because it's avoiding the down days. Right? It's doing the same on the up days. So by avoiding the drawdowns during poor seasonal periods, it was able to generate substantially better returns. All right, so that is conceptually how the quantifiable edges seasonality calendars look at creating the models. So we use machine-based learning and create a similar approach to generate model data over a long period of time, rather than just having one simple day of month model. I incorporate a number of different models, okay, and they'll look at different things as well, because as I mentioned, sometimes day of week works, sometimes or matters more than day of month, or it might be time of year or quarter or whatever it is. Then what we do is we average the results together to create ensemble statistics. So if one model says there's a 60% chance of an update tomorrow and the other says there's a 50% chance, then with the data we show says 55%, right? If you're looking at just two models. So we average the statistics together, and that gives us the ensemble stats. Then we provide historical data, and I'll show you that, to let people do their own analysis, and you get tools to evaluate and backtest all of this data easier. So here's an example of a seasonality calendar. This one is the S&P 400 mid-cap calendar for December of 2020. Quick things to note here are that the days of positive seasonality appear in green, days of negative seasonality appear in red, and days where it's neutral appear in white. We show stats for each of the days, including, you know, average win percent and average percent change for the ensemble on those days, and you can refer to this calendar, you know, throughout the month. Not only can traders see what's expected over the next month, but you can also see what the calendar algorithms would have shown historically by downloading historical data files. So newer indices might only show back to, say, 2000, but like the S&P and the Dow, we go all the way back to 1940. So there's plenty of data to analyze, and I've also developed tools to help traders explore the data easier. So those tools are available in Excel and TradeStation and just in the last week or so, or a couple of weeks, AmiBroker. So you can take all of the historical calendar data and say, hey, I want to filter in a way that you can create a report just like the one I showed. This is an example of from a report that I created, and it looks at model results of only being long the S&P on days that would have shown positive expectations based on the calendar algorithm. So just like the one I showed earlier based on day of month, this is the same thing. We're looking at if the win rate is at least 50% and the average profit factor is at least 1. And it's pretty eye-popping, the outperformance here. What's especially encouraging is how they were achieved. Right, it wasn't through these large-scale optimizations that found random, perhaps meaningless streaks. It was combining simple models to make the ensemble, and then you're rolling the averages forward to generate entry and exit signals. Bottom line is, there appears to be a lot of value in the concept, and that's gotten me very excited and why I've done so much work on this lately. All right, let's talk further now about, all right, I'm not really a long-term trader, and I don't want to trade in and out just based on seasonality every day. How could this help me with my swing trading? Because a lot of people that follow quantifiable edges are swing traders. I myself do a lot of swing trading. So let's start by looking at a very simple swing trading system. I call this the 5-day low, 5-day high strategy. And it's not a system I personally trade. It's just a nice example of buy a pullback, sell when it bounces. Okay. The entry rule for the 5-day low, 5-day high system is we look at the SPX closing price in relation to the last 4 days. If today's closing price is the lowest out of the 5 days, and it's above the 200-day moving average, we're going to enter long at today's close. Okay, so you're getting long the S&P at the day's close anytime it closes at a 5-day low. For the exit, again, we're looking at today versus the last 4 days. If today is the highest closing price in the last 5 days, or if the S&P drops below its 200-day moving average, we're going to exit at the close. Okay, so those are the rules. That's it. Here's some sample signals here. So I wanted to show examples of winners and losers, but as you can see here on the on the left-hand side, we have a 5-day low close. It buys. It holds on until there's a 5-day high close, and then sells at the close there. This happens again a few weeks later. The market moves down. S&P closes at a 5-day low. It's bought, and it's held until a 5-day high, which happened 4 days later, for a decent gain. Shortly after that, we have another 5-day low. This time the market kept selling off, and it took a while before the bounce brought it back up to a 5-day high, which turned out to be a loss for the 7-day period or whatever it was. Okay, so this is what the trades would look like in this simple 5-day low, 5-day high system. Now, what if we want to incorporate a calendar filter? What I would do here, or one way to do this, would be to require that the Quantifiable Edges Seasonality calendar, the win rate for tomorrow, if you're going to go in, you don't want to go in ahead of a weekday, so just make sure that tomorrow shows a win rate of at least 50% and a profit factor of at least 1. Other than that, the rules are the same, right? So we're not going in when the calendar shows weakness. We are going in when it shows strength. Here's how the results would have looked since 1980, right? Without the calendar as a filter, we got 597 trades, 16% exposure to the market, so that means you're in 16% of the days. Here's your net profit, $152,000. This is based on $100,000 a trade. Average trade is 0.26. Max drawdown is $25,000. With the QE calendar, you can see the numbers of trades, exposure to the market, average are both reduced quite a bit. Net profits are almost as strong. Drawdowns and average trade improve. In fact, over on the right-hand column here, we can see the differences where you've got a 42% less trades, about 38% less market exposure. Total profits are only down 12.5%. Your average trade is up 50%. Your max drawdown is 39% less. So far less exposure, much less drawdown, greatly increased average trade, and almost the same profits over a 41-year period. Seems to be a worthwhile filter, right? So that's how I would utilize the calendars for short-term trading. All right, I've gone over most of the features within the Quantifiable Edges seasonality calendar. I'm just going to talk about it a little bit more here, but you've seen a sample calendar. The historical data is available for all 10 indices we currently track. We have research reports that I've released, and there's also backtesting tools available, as I mentioned. Additionally, there's a Google group for users that want to exchange research and ideas related to seasonality and related to the new calendars, or if they want to update code or anything you want in there. For people that are already subscribed to Quantifiable Edges, seasonality is included with all gold and silver subscriptions at no additional charge. I put it in there. I wanted to make it a big enhancement. And so I haven't, there's no additional charge for current subscribers. That means you can sign up for a gold or silver subscription still and get it, the full seasonality functionality. If you only want the seasonality functionality and you're not interested in anything else about Quantifiable Edges, that would be $20 a month or $175 a year. So keep it very low cost. You can feel free to email me at support@quantifiableedges.com. Let me know if you have additional questions on any of this. And now I am looking forward to taking any questions you guys might have based on anything I shared here today, or if you have questions, in general about swing trading or seasonality or what have you, I'm happy to answer them as well. Let me see if I can move over to the chat box. I'm going to stop the recording right here.